my name is Mathew Owens, and welcome to the Masters of Real Estate. Today, I am going to talk to you about what recession-resistant real estate and investing really means, okay? Some of the strategies that I implement, I'm going to talk about 5 key strategies that you guys can implement in order to actually really reduce your risk of an upcoming recession, so you can make sure that you have good long-term cash flow in place for your investments and weather the storm in real estate or non-related assets in business and your positive cash flow stream, so that you can retire and really feel a lot more comfortable that you're in the right positioning for a potential market correction or potential recession and things like that. Okay, so let's talk about those 5 things that I think are extremely important for you to actually be able to be successful long term and be able to deal with those market volatility and the market fluctuations. You don't want to be like me in 2008 when I quit my CPA firm job first thing to go into real estate full time in 2006, and then in 2008, of course, got punched in the face, took a major hit, lost massive amounts of value, and was structured completely wrong. And so now I'm always looking out for that left hook. Where are you going to get punched in the face again? How do you actually make sure you protect yourself going forward? That's the key to this whole thing. Okay, so the first thing that you should be focusing on when you're trying to protect yourself is investing in assets where you can get some sort of built-in equity in place. So you want to be looking at what the market value is now and what you're buying for right now, as well as what the value is going to be worth after you renovate it or after you do a value add improvement to that asset specifically, so you can really be gauging what your cost is compared to that after repaired or after improved value. Okay, so making sure that you have a big enough gap there to weather the storm so that you don't end up upside down and underwater and then negative cash flow on top of that and be in a really bad position. That's the worst thing you can have happen, is to be underground on equity and being negative in cash flow, because then you just can't hold it long term to get out of it over the long run. You have to actually sell it because you're bleeding. So making sure that you protect yourself from an equity position is absolutely key to mitigate for that downside risk, of course. And you can do that by buying right. You can also do that by adding value, doing the renovation, increasing rents, doing infrastructure development and stuff like that to add value to that asset in the first place, so you can build that equity in. Okay, so that's number one. Number two is watching out for where your debt stack is right now. So being very, very strategic and careful with how you are getting debt, the terms of that debt, the length of time of that debt. You don't know what's going to happen in a couple of years, right? You don't want to get really short-term debt and then have the lending market blow up on you, especially if you're dealing with multifamily or mobile home parks or other assets like that. You want to make sure that your debt is long-term enough to weather any upcoming storm that may be coming, right? There's something like $1 trillion worth of commercial debt that's going to need to be refinanced in the next few years, and right at the same time when there's a big lack of buyers of that debt. So super important to understand and make sure that you have the right the right debt stack in place, so that you don't take on undue risk in 2 years or 3 years where you can't refinance in that time, or there's a big problem. Do you have extensions on your debt? If you're going to get a 3-year or a 5-year debt, can you go through and get a couple of extensions built into that so that it gives you more time? For example, like commercial real estate has refinance issues and timelines that you have to deal with, versus residential where you can get 30-year fixed rate mortgages, right? So you got to be planning ahead for that value add and making sure that your loan to value is low enough so where if the market changes, if rents drop, right, and the market values drop in a couple of years, are you going to be able to still refinance based on your current cash flow? Are you being comfortable enough in your debt service coverage ratio, your DSCR ratios, to where you are able to weather that storm when the rents do inevitably drop, when the market values and the cap rates get worse, where you're not selling it for as much as you used to be able to sell it for, because of that softening of the market down the line, because of the lack of debt that people are able to get on these projects, which typically prop up some of those values. So you want to be really, really careful with that having low loan to value, really good debt service coverage ratios, and longer terms on that debt to protect yourself. Okay, so number three, okay, being very conservative on your after repaired values. Okay, so if you're into the property for 60 cents on the after repaired value and the market drops by 30%, are you still going to be okay? Can you pick the lower of the market whenever you're in a down market or you're in a market that may be correcting? You don't want to be swinging from the fences with those top comps. You want to be building in a reduction into your acquisition cost and your purchase price in order to counterbalance a potential drop that could occur in that period of time. So maybe if you think it's going to drop in that market by 10%, for example, then maybe you build that extra buffer into your purchase price right off the bat to make sure you have the right loan to value. But in addition to making sure you have the right cost to after repaired value, being conservative up front on what you think your current values are and building in a reduction is key. And a lot of flippers, for example, get in trouble with this, where they get bailed out in an up market because their efficiencies and systems aren't up to par, but then in a down market they take a major bath because they don't have things dialed in and they're being too aggressive and not dialing in that after repaired value reduction in value that may occur during a recession, right? So and then so we got 1, 2 for built-in equity. We got watching out for your debt stack, number 2. Number 3 is having conservative after repaired value assumptions. And number 4 is building in a rent reduction into your calculations and saying, where is my break-even analysis? Where's my break-even if rents drop by 25%? Am I still doing okay? Am I making a decent return even if rents do drop by 25% above market? Maybe you have this big plan to go renovate units and add more units and increase rents massively across the board, but what happens if those after repaired market value rents that you currently have comps on drop by 25% from where they should be long term? Are you still going to be okay when it comes to that rent drop? Are you still going to be break even or making money on your money and having a debt service coverage ratio to where you can refinance that property in a few years? Because you don't want to be in a position where rents drop, market values drop, and your income drops, and therefore you then can't go get refinanced afterwards on your 3 or 5 year term or your 7 year term there. Okay, so those are absolutely key. And then the last piece is super important to understand is investing in the right types of assets and the right structures of those assets in the first place. So for example, I invest in a lot of short-term debt, right? They come with high interest rates. They're relatively short-term, 6 to 12 month type terms. I'm at like 65% of the after repaired market value typically on average, so got good equity position. Short term, even during the market crash in 2008, it took 6-7 years to get to bottom. It didn't just crash like majorly 50% overnight across the board or 20% overnight across the board. It took time to get there. So being on a short term cycle like that enables you to reassess what the new market value is on every new asset that comes in the door on a short term cycle like that, right? And you have someone else putting the capital down on the down payment down on their purchase if they're doing their flip, and they usually have built-in equity involved on top of their down payment. So there's some good equity positions in short-term debt obligations like that, and I think they're a great strategy from a high cash flow perspective and a low risk mitigation from a recession-resistant type asset perspective. One of the other things I think you should definitely consider is alternative assets. So really important to diversify your portfolio into gold, silver, commodities, different mining stocks, and things like that that can add a major protection. If everything falls apart over here, then you still have a nest egg over here that probably went up in value, especially with some of the supply and demand metrics that we're seeing out there, where there's a massive supply imbalance when it comes to the commodities and the potential need for those commodities in the future with regard to natural resources. So key to understand there, right? In addition to that, like I invest in accounts receivable financing and different ATM machines, different cash flowing businesses that make money in a different way, that might be recession resistant, that are going to continue operations even during a downturn and continue to actually pick up steam and actually do well during a downturn. So looking at diversifying into other types of assets that can create a buffer so you're not fully invested in real estate, you're not fully invested in commodities and mutual funds and things like that, and gold and silver and things like that. You have to have a proper diversity so that you can protect against that downside risk, of course, as well. And then, for example, I do single family homes, and I invest a lot of those with zero debt because I want to make sure that I have a good asset that's actually performing, really doing well, actually cash flowing like crazy, versus having a debt that actually reduces that cash flow, increases the risk associated with that deal as well. And I get built-in equity on my single family homes as well as my other deals that I do, and where if I'm not using debt and I'm getting built-in equity, and I'm allowing for myself to go buy new deals in the future if there is a reduction in values, to pick up properties at even bigger discounts, because when things do crash, you want to have dry powder on deck to be able to make sure that you can acquire new assets that you can get at massive discounts. When the market is going down, that's the time to get, you might be getting normally a 25% discount on a property, but in a crash, you might get a 50% discount on the current value of that property. And even if it goes down further, you're still in a great position because people are running scared. And when people are running scared, that's when you buy. That's when you're there. So you want to make sure that, I invest in things that don't have a lot of debt on them right now, so that way I have, no worry about a debt service coverage ratio issue, no worry about a refinance issue on the back end. Those things are really, really key. And then one of the other assets that I heavily invest in is mobile homes. And the reason I like those is because they typically have a higher upside potential than multifamilies or other assets when you're talking about the ability to improve them. You're going in and renovating existing park owned mobile homes that people just left there, and you're now renovating so you can release those. Take some capital infusion, but you can really increase the value of the park that way. In addition to that, a lot of these parks have no homes on empty lots, where if you brought in homes and individual houses like this, or individual mobile homes to purchase for homeowners to buy, you're now filling up empty lots with additional income streams across the board. There's utility recapture programs. There's all different types of value add strategies. And from the recession resistant aspect of this, when you're looking at mobile homes specifically, that multifamily tenant that can't afford the multifamily rents anymore will typically drop down to a mobile home. So you have a barrier or an actual additional tenant there, and you usually get more demand for mobile homes during a recession than you even do during an up market, because there's more financial distress, and so people need to go to an even cheaper living environment than they're normally used to. So I hope this helps you guys get clarity on some of the strategies I use to have recession resistant portfolio and be able to weather that storm, and the lessons I learned from taking that punch in the face last time, of course, when I first got started investing. So I hope this helps you guys, and have a great rest of the day. Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. Three of the key pillars to becoming a successful real estate investor. Number two, you can join us on our mailing list, where you'll get tips and tricks on real estate investing directly to your inbox. And number three, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.